Yeah. I'll repeat the question just because I started the recording now. What is meant by investment property? Why there is a separate standard for investment property? Why couldn't it be clubbed with PP? Why? Lot of questions to be unanswered. I think I've received some. Melvin says it's not used for operations. Okay, but why significantly a different accounting standard? Anybody? Because we have gone through IAS 16 in full. Okay. The reason why there is an investment property is it's for much better information, much drill down, much breakup of information to the users of the financial statements. Okay. If I classify something as investment property, I know that I'm not using it actively in my production or supply of goods or services or for administrative purposes. I'm not using for all those things. Yet I am just keeping it astray for getting some capital gains or entering. So that becomes very clear to the users of the financial information and hence such a distinction. Okay. Now, an entity may own land or building as an investment rather than use in business. It may therefore generate cash flows largely independently of other assets which the entity holds. The treatment of investment property is covered by IAS 40. Okay, so there is a difference, even though these are just like another PPE, but we for enhancing the decision making of the users. Let's say that I'm going to take over your operating activities and I say that large chunk of your PPE is investment activity, and I know that you're not invested much on your operations in the first place. Getting it? So that kind of information can be tangible or usable by the user only if it is separately disclosed, and that is why there is a separate standard on investment property. Now let's look at the definition. So investment property is property, land or building, or a part of building or both, held by the lessee to earn rentals or for capital appreciation or both, rather than for use in production or supply of goods and services. So exactly. Am I audible? Because I can see that my internet connection is unstable. Yeah. Okay. Am I audible now?
Okay.
Sorry?
Okay.
Okay, fine. Fine. So if there is any break, let's stop. But I didn't go to anything. I was just looking at the definition of investment property. So investment property is land, building, or a part of a building which is held by the less okay, to earn rentals or for capital appreciation or both. So it is not used in production or supply of goods or services or for administrative purpose or sale in the ordinary course of business, right? So if I have a property which I'm not using for production or supply or goods or services or for administrative purposes, or I'm not selling such property, that is not my business, then I can value such a property as an investment property. Okay. So what is owner occupied property? Is the property occupied by the owner, okay, for use in the production or supply or goods or for administrative purpose. So how would the owner occupied property be accounted in using which IFRS? Owner occupied property. I told you that investment property is not used. Okay. Not used in the production or supply or goods or for administrative purposes or sale in ordinary course of business. So anything which is not used for their active business is what is an investment property. It is just kept for rentals and capital appreciation. What about owner occupied property? We will account it as per which standard? Hello, am I audible? So owner occupied property, we will account as per IAS 16. Okay. And then there is the definition of fair value. We know that what is the definition of fair value, which is the price that would be received to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. Okay. And cost is the amount of cash or cash equivalents paid at the initial stage, okay, to acquire an asset at the time of its acquisition or construction. And carrying amount is whatever is cost minus accumulated depreciation. So these are all definitions which we already know, right? So few of the examples of investment property. Am I audible? Like, is there any problem?
Sir.
It's okay, right?
Yes.
Okay, let's do something different then. Let's do something different. Okay, just instead of looking at the definition, you tell me this. Okay, thank you. You tell me this. So I have a range of properties. Okay, so one is first thing, what is the definition of investment property? It is not used for rentals, sorry, not used for production, supply, and admin purposes. Right? And it is not held for sale to others. Right? This is what we learned as the definition of investment property. Correct? So you tell me few things like, what about, see, I am a developer holding a block of land or holding a block of properties. I develop these properties. Is it a investment property for me? I am a developer. I earn my daily income by sale of properties. I have a block of properties in my hands, which is which is capitalized in my books. Can I capitalize it as IAS 40 or do I capitalize it as IAS 16? Yes or no? Hello? Yes, I get the answers. Sahil says it is IAS 16. Okay. Any other answer? Okay, since nobody wants to participate, please understand that developer holding a block of property. See, I'm a developer, I developed it. Unless, so there are three things. If I am using it for my, like, say, hosting my staff or like, as my office building or doing it, then it becomes PPE. Okay. If I am not using it, I'm just letting it there for some, I'm unsure what to do, or I'm just letting it there for some capital appreciation, then it becomes, then it becomes, then it can be brought under IAS 40. But let's say that since I'm a developer, I make a living by buying and selling. So that becomes my inventory. Okay. So this is one area where they will test you really well. Okay, if I am using it, if like say Damac is having their central headquarters, it might be built by them, but still it would be IA 16 PP because they are using it. Damac has built something, they are not using it, but they are just keeping it for selling to others, inventory. Damac has a group of properties which they developed, but they don't know whether to sell, whether to keep it, or whether to kind of like, then go by IAS 40. Okay. Now, DAMAC sense, we cannot put it as IAS 40 because it would effectively be an inventory. But for anybody else, if they are not using it or they're unsure about it, then it goes to IAS. Okay. Is it clear? Is it clear? Hello. Okay. Fantastic. Thank you, guys. Now, let's move forward and see some of the examples instead of reading it out. Now, let's say that I took an asset on lease. Okay, let's say it is a finance lease. And I further rented it to others. Okay. Property is not my property. I took it on lease, okay, on a finance lease. And for me, it is what it is going to be in my books an ROU asset. Correct. Now, in such a scenario, I took an asset, okay, on lease. I'm not using the asset. Okay, I'm not using the asset. I have actually given it to somebody else for rent. So that's a classic case of subletting. Hmm? In such a scenario, can I put that right to use asset? Okay, right of use asset as IAS 40 instead of IAS 60. So we'll call it as subletting cases. I took it as a finance lease. I'm not using it. I'm not using it. Okay. I took it as a finance lease and I'm subletting it to others on an operating lease. So it is plainly like, a subletting arrangement. Can I keep this right to use asset? It's not an owned asset. It's a right to use asset as IAS 40 instead of IAS 16. I hope the question is clear. Yes. Ashik says yes. Yes, in what context, Ashik? Yes means can I keep an ROU asset as a investment property? Okay. See, you're right. So even if it is an ROU asset, okay, if I took it on a finance lease and I have an ROU asset, if I'm not using it and if I'm subletting to others, I can take it as a IAS 40 as an investment property because it fits the definition, not used for production, supply, and admin purposes, right? And not held for sale to others. I'm not Damak. It's not, I mean, the title deed is not mine. It's then the name of the actual owner. It's just an ROU asset and I'm not selling it to others. I'm just subletting. Yes, you can kind of keep it as a RU asset. Oh, sorry, I can keep it as an investment property. Good. Now I'll have one more case and then we will go back to the question, go back to the. So what if let's say that, the parent company has a property, okay, and lets it to subsidiary. What happens to these kind of things? Okay. So parent company has a property. They are not using it. They have actually given it to the subsidiary for use. And subsidiary is conducting their activity there, their main activity. But in the parent company's books, can I keep it as an investment property? Yes or no? Parent company is not using it for production supply, but its subsidiary is, and he has let it to the subsidiary. Can this asset be classified as a PPE or an investment property? In my books, that is the parent company's books. Yes. Melvin says IAS 40. Yes, but effectively, do you see the contradiction here? Like, it's me, it's kind of like my subsidiary only. Okay, it's 100% holding subsidiary. He is using it for his, so would that mean that I will also be use it as for my administrator purpose? The answer is no, you're right. I can do it as IAS 40 only. Okay. Now there is a catch. IAS 40 I can use because it fits the definition. Even though my subsidiary is using it, it fits the definition. IAS 40 in the parents' books. But at the time of consolidation, there is a problem because the same asset is there as ROU asset in the books of or same, so in case of consolidation, there is a problem because the same asset is used for admin purposes by the subsidiary, but it is an investment property in the books of the parent company. So in such a scenario, what do? We will classify the property as PP. IAS 16 because we are effectively using it. So it's a consolidation. So I own, I only use it. So it do not fit the definition of IAS 40 anymore. So then at the time of consolidation, it becomes a PPE. But in the parent company standalone books, it could be a investment property. Are you getting this distortion? Yes or no? Because these are subtle things which we will make a mess of it. Did you understand parent company's IAS 40 treatment?
Still, no.
Okay, okay, no problem. So what I was trying to say is that, in IAS, see, it can be a IAS 40 asset in the parent's books because it fits the definition. It's not used for production, supply, and admin purposes, right? The parent is not using it. It has let it to the subsidiary. But at the time of consolidation, when I'm consolidating the books together, there is a problem because in the parent company's books, it's IAS 40, but effectively this asset has been used by the subsidiary. So at the time of consolidation, when we are considering both the companies as one, if you see the both the combined consolidated people own the asset as well as use the asset. So that time, at the time of consolidation, this would be reclassified into PPE and it will not be put as an investment property in the consolidated books of accounts. Getting it? So these are subtle things which will happen. So if you have cases where you have to break down, you have to say we have a lot of cases where we are doing a combined books of accounts. And the combined books of accounts, if you're breaking it down to standalone books of accounts, then there or standalone books of accounts, we are combining into a consolidated books of accounts, then this has to be taken care. You have to see if any investment property is there in the parent and that investment property is led to the subsidiary. Are you getting it? Okay, but be very careful. This is a little subtle and it will come. So with that in mind, we will go back to the. So some of the examples of investment property include land held for long-term capital appreciation, right? A building owned by the reporting entity and leased out under an operating lease, right? So that means even an ROU asset, if I am letting it out under an operating lease, it could also be an investment property for me. A building held by a parent and leased to a subsidiary. Note that while this is regarded as an investment property in the individual parent company financial statements, in the consolidated financial statements, this property would be regarded as owner occupied because it is occupied by the group and will therefore be treated in accordance with IAS 16. I think this should be clear to you now. C and D, property that is being constructed or developed for future use as an investment property can also be put as IAS 40. Okay, let's do this question. Now you tell me what is the answer. Rich Co owns a piece of land. The directors have not yet decided whether to build a factory on it or use in its business or keep it and sell it when the values rise. So he's unsure whether to kind of like, he has a land. He's unsure whether to build a factory on it or whether to kind of like, sell it. So what do we do? Can this be classified as investment property? Okay, yes, because first thing is we cannot classify it as PP because for classifying it as PP, you have to have a tangible asset which is used in production. So here it is not used in production, supply of goods or services to rental to others or etc. Right. So it does not meet the definition of PPE. It only meets the definition of IAS 40. Okay, so that is why we will be considering it as IAS 40. Yes, if an entity has not determined that it will use the land either as owner occupied property or for short term sale in the order, and the land is considered to be held for capital appreciation. As simple as that. Now, let's come to accounting treatment, right? So for accounting treatment, let's first do the Excel and then we will come and read. I think that's better to do it. Okay. So let's do accounting treatment. This is all about definitions. Now for accounting treatment, there are few steps, right? And I want you to reproduce the same steps for the exam also. What are the steps? We discussed this in the last class. What are the steps in accounting treatment? steps while accounting. What should you do? What are one, two, three, four? Yes. Okay. First one is recognition. Okay. So first one, let's do recognition. Recognition could be of two types, right, Sahil? A and B. Right. So there could be initial recognition and right. Then there is measurement, and measurement is also initial and subsequent measurement. Then what? Then we have to see depreciation, right? Since it's a PPE, we have to see depreciation and other things, not just on the asset, but other things as well, right? Then, like, whether there is any, OCI elements which is used. And finally, there is presentation. Okay. So let's see kind of like, what we can do in each. Okay. So you tell me now, what is recognition? When do I recognize? Yes, very good, sir. So when do I recognize PP? Yes, am I audible now? Okay, when do I recognize when do I do an initial recognition? When do I do it? That's what we have been looking at all these cases, like, when it is not used for production, supply, and admin purposes and not held for sale to others. Okay, it should satisfy the definition of investment property. And then at the time of initial recognition of PPE, we looked at two separate things. What are those things? Two, one thing is it should satisfy the definition, right? Initial recognition, there are like satisfy definition. Then there are two separate conditions as well. What are those two separate conditions? It should satisfy so as to record. This is called recognition. What are those two conditions? If you recall, it's the same as PPE. Hello? Yes. See, it's not future economic benefits. It is probable that future economic benefits would arise. And also, the cost can be reliably measured. Okay. So this is what is the recognition pattern. Now measurement. Initially, how will we measure? How did you initially measure? So you could recognize only if those two conditions are satisfied. So I'll write those two conditions. Probable that future economic benefits will outflow and also cost can be reliably. Okay. So if you make such notes, right, it's very easy to kind of like, go through. It's very easy to, no need to elaborately read things. Now, measurement. When do I initially measure? How do I initially measure PP? Sorry, how did I initially measure PPE? How did I initially measure PPE? How do I measure PPE? Am I audible? How do you measure PPE?
At cost.
Yeah, at the initial measurement is always at cost. Okay. Initially, we will look at cost. Now, what are the things which we add in cost? We looked at it that day, like non-refundable taxes, purchase cost, any direct cost which is spent on bringing the goods to its or bringing the asset to its present location and condition, including capitalized borrowing costs. Okay, we'll look at capitalized borrowing costs next, but first, initially, what is the sum of its cost? That is what we will use. And we saw various permutations as to what cost should be included, what could not be included, like training cost, etc., should not be included because it is not used to bring the asset to its present location. Okay. So initially at cost, same PPE also initially at cost. Subsequently, PPE, there is an option of, there are two options. I can choose either one of them as a policy. What else is I can choose either a cost basis or a revaluation basis. Here there is a subtle difference. Only thing is I can even choose cost basis or fair value basis. Okay, so that means I have to do it on fair value basis or cost basis. There is no revaluation method. Now you tell me one thing. What was the formula for cost basis? Cost basis, if you recall, our formula was cost minus accumulated depreciation equal to carrying value. That is how the cost basis was arrived at. Now, in revaluation basis, latest revaluation minus subsequent accumulated depreciation minus subsequent impairment cost would bring the carrying value of the asset. Right. Here, the only difference is it's all the same, but there we had a provision as to like fix the date of revaluation, right? I mean, some assets we'll only do once in 3 years or once in 5 years, or highly volatile ones only we will do every year. Here, for fair value basis, we have to do every year. Okay. And in revaluation basis, we only had to select the, see, if I choose revaluation basis, I only had to make those class of assets as to revaluation method. Correct. For example, let's say that I am doing land alone in, let's say land, I've kept it as PPE, and land I am choosing a revaluation method. All the other land that I own should be used. That class of assets should also be on the revaluation model. Here, what they say is if I choose fair value, then I have to do fair value for across all investment properties. So it's not just a class of assets, which is land, but building and anything for that matter would now go into fair value method, and fair value has to be done every year. Okay, there is no 3 years 5 years condition, and all investment property should now be in fair value basis. So these are the two important differences that is there, you know along with PP. Now you tell me there is one more thing in the basis of accounting. Now, in case of accounting, let's say that there is a revaluation gain or a revaluation loss, right? If I choose the revaluation method, and revaluation gain, where do I post it? In if it was a PPE, and if I'm choosing the revaluation method, where do I post the revaluation gain? Can you type it out because that's more convenient to me? Yeah, we do it at the OCI, but here please understand we do it in P&L. Okay, all the FP changes, fair value gains and losses, we will be putting in SOPL and not OCI. There, the gains would go to OCI and losses would come here. Here, everything and everything is in P&L only. So, in case there is a subsequent fair value loss or gain, no need for adjustment. Okay, because everything is going straight into SOPL. Okay, the reason for that is like, we are putting it onto the fair value every time. So this is the version of tangible assets which are treated as fair value through P&L. Okay, you can think of it like that. But all the fair value gains and losses through SOPL. Okay, you have to do, these are subtle changes. You have to do it every year. So since you're doing it every year, would there be a depreciation for this asset? Tell me, think of it. If I'm doing every year, would there be a cost called depreciation on investment property? In revaluation method, what is the, how do I find? Like, we look at, yeah, we look at, cost. Sorry, we look at revalued amount minus subsequent accumulated depreciation minus subsequent impairment loss. Correct. Now, in such a scenario, if I'm doing it, that happens because I'm doing it 3 to 5 years. Right. Now, if I'm doing it every year, there will not be a depreciation at all because there is no subsequent. Every year I have to do it. So there is no subsequent depreciation or subsequent impairment gain which comes and hits us. Is that clear? Okay. Subtle differences, only three things. You have to do it every year. Uh, and it's not just all class of assets, but all investment assets. Okay. All investment property. If you're choosing fair value method, everything would go into fair value. Not just land or not just building, but everything. Okay. Not the class of assets. And third thing is every fair value gains and loss will go to SOP. Okay. Depreciation is very clear. Unless you choose cost method, there is no depreciation. So either there is cost method or either there is fair value method. There is no other method. There are no differences like some assets in fair value, some asset in cost, and that doesn't happen mostly in fair investment property. Either everything or nothing. There are no OCI elements. Okay, but there are a few things in presentation or like few things which we have to take a look at. For example, one thing is what happens, we have to look at how what happens when it is derecognized. Okay, and also transfers between IP and PPE. So when investment property becomes PPE and PPE becomes investment property, what would be the accounting? So these are the only things, but is recognition and measurement very clear to you? Recognition, measurement, we will be reading about it, but just as a front note, I thought, is it all clear? Yes or no? Hello? Okay, fantastic. Thank you, Sahil. Now let's go and read the books and now we can see. So investment property prescribes accounting treatment for investment property and related disclosure elements. An asset held by an entity as a right to use asset under IFRS 16 and leased out on operating lease is treated as investment property. You now know what is an investment property. Below are few examples of items that are not. So property intended for sale in ordinary course of business, I told you it is inventory. Property being constructed, developed on behalf of third parties, it's a contract asset and that is IFRS 15. And owner occupied property is IAS 16. Okay. Some properties may be partly owner occupied and held for investment purpose. That is one thing. Under IAS 40, if these portions could be sold separately, an entity could account for portions separately. So there could be an instance like, say there are like totally, let's say that, I am 4 stories, out of which one story is held by me. Okay. can I treat one story as PPE and the rest three stories as, yeah? Am I audible now? Hello? 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 Can you hear me?
Yes, sir. Audible and
Okay, okay, fantastic. So
hello.
what I was telling is, Melvin, let's say that I have got a building which is 4 stories high, out of which one story, or let's say one floor is used by me, and other 3 floors are let out. Okay. So in such a case, can the other 3 floors can be held as IAS 40? In such a scenario, can I let out, the ones which I'm letting out, can I treat it as IAS 40? Okay, Sahil, the problem here is what happens is the value that I paid for construction of all the asset, everything is just one amount. Okay, for 4 stories, I paid one amount. If it is capable of being sold separately, like you can separately sell one story, second story, third story, fourth story, then you can account it as different. Otherwise, you have to club it and account it as PP. Okay. So that is the main difference. It should be the keyword is capable of being sold separately. If it is capable of being sold separately, then yes. Okay, because if it's capable of being sold separately, it would have a purchase cost. Correct? You have to do the stamp valuation and all, you have to do the purchase cost. So if it is capable of being sold separately, yes, you can, 3 stories can be IAS 40, and one story is it should be IAS 16 because it's owner occupied. But sometimes what happens is in the same factory premises, half of, or you can see a lot in Dubai, we'll do partitions and so. Is the partition capable of being sold separately? No. In such a, we can only sell one house. Correct? So not the partition. So in such a scenario, you cannot account for that partition as a separate IAS 40. You should account it as PP. Is that clear regarding a part is owner occupied? So you know what to do cases when part of the property. Yes, you should only look at this one. Is it capable of being sold separately? If it is, then account differently. If it is not, then account together as PP. Clear? Yes or no? Okay, fantastic. So that's what they are saying. Some properties may be partly owner occupied and partly held for investment purposes. Under IAS 40, if these portions could be sold separately or leased out separately under a finance lease, an entity should account for the portion separately. If the portions could not be sold separately, the property is investment property only. If a significant portion is held for use in the production or supply of goods and services, or if only a insignificant part is owner occupied. Okay, so you have to see, if it's only an insignificant part which is owner occupied, that is, I have a building and I have a security room, then it is okay. Then everything can be IS 40. But you have one floor, it is significant, it's 1/4 of the whole property, then you have to see if it could be held, it could be sold separately. If it is not be capable of being sold separately, then you should kind of like, then you should kind of like, keep it as IA 16, or you have to decide then. Now, recognition, we looked at that. When do I recognize? It is probable that future economic benefits associated with the investment property will flow to the entity and the cost of the investment can be measured reliably. Then you recognize. So, first thing is it should satisfy the definition, then it should satisfy the recognition criteria, then you do the initial recognition. Initial measurement should be at cost, including transaction cost. So if it is a right to use asset, I told you that right to use assets can also be termed as IAS 40. Then right to use asset, the cost, the initial recognition is based on IFRS 16. Okay. So you find the lease liability and the asset. So the same recognition can be used here as well. So for right of use asset, which is now presented as IAS 40, you can use the IFRS 16 mechanism to find out the cost of ROU asset. Okay. Now, measurement subsequent to initial recognition, you have two models. The fair value model, it's not the revaluation model, it's a fair value model and the cost model. Whenever, whatever policy it chooses should be applied to all its investment property. See, it's not class of assets, it's all of its investment property. Under IFRS 18, an entity is required to assess whether it invests the assets as a main business entity. If an entity has investment properties as its main business activity, then it should be in operating, otherwise it should be in investing category. That's okay, that's fine. Now, fair value model, after initial recognition, an entity that chooses the fair value model should measure all of its investment property at fair value, except in extremely rare cases where it cannot be measured reliably. Okay, so emphasis on all of its investment property. Okay, a gain or loss from change in fair value of an investment property should be recognized in net profit or loss for the period at which it realizes. Okay, it should be directly into SOPL and not into OCI or anything else. The fair value of property should reflect market conditions at the end of the reporting period. So it should, the fair value should be computed in relation, in accordance with IFRS 13. Okay. Now this is fine. They are just kind of like, telling what is fair value. Now cost model is same as depreciation. Whatever is the initial cost, less accumulated depreciation cost, less any accumulated impairment losses. Okay. So, but there is a presentation change. An entity that chooses the cost model should disclose the fair value of its investment. So you have to disclose. So see, the standard actually wants you to do as per fair value model because it gives the best presentation when it comes to investment property, not cost. So if you're using cost also, just present, disclose somewhere in the notes that this is the fair value of the investment property that is that which I am doing it at cost. Okay. So now there is a changing models. Yeah, once the entity has chosen fair value or cost model, when it comes to changing models, it would be what? A change in accounting policy. Okay, it's a change in accounting policy and it has to be done retrospectively. It's the same as PP. Yes, now we'll look at transfers. Transfers to or from should be made only if there is. Now let's look at transfers. Okay, are you with me? Am I audible, clear, everything? Now let's look at transfers to and from. Okay. So we have only done this. Okay. Initial recognition, initial. Sometimes, yeah, now it's clear. Initial cost, subsequent analysis, depreciation, etc. Let's do transfers. So what happens? What could be the permutation and combinations involved? By transfers, I mean, transfer from investment property to PPE and vice versa. Okay. So what should you do there? How many permutations, combinations could be there? Permutation combination number one, PPE, which is done at cost, to transfer to IP, which is using fair value model. Correct? This could be one permutation. Second permutation is PPE, which is doing revaluation model, to IP, which is being doing fair value model. Right? Now the same in this way also. There could be many combinations in this, like, PPE, which is cost, right? And which is IP at cost. Because each has two methods, no? PPE at to IP at cost. Okay. Now fifth, what could be, this is one, and then there is the same where IP is transferred, correct? IP fair value to PPE cost, right? Then IP fair value to PPE revaluation model. I investment property in cost to PPE in revaluation model or cost, and IP cost to PPE revaluation model. So totally there could be 8 permutations and combinations in the transfers, correct? Yes or no? Okay. Now if this is clear, let's do a little reading and then come back. Okay. Transfers to or from investment property should be only made when there is a change in use. So you have to see whether there is a change in use. I'm not, PPE is not used for my activities, it is just arrested. Okay, or an IP which is normally rested is now used for active. So there should be a change in use. For example, owner occupation commences, so the investment property, okay, whatever. When there is a transfer from investment property carried at fair value to owner occupied property or inventory, the property costs for subsequent accounting under IAS 16 should be its fair value at the date of change of use. Okay, conversely, an owner occupied property may become an investment property and need to be carried at fair value. Entity should apply IAS 16 to the date of change of use. It should treat any difference at that between carrying amount and property under IAS 16 and its fair value as realization. Again, diarrhea of words, but let's see how it kind of like, is done. So what they're telling to do is, it is pretty simple. Though you don't need to go on case to case basis. If you are transferring from cost to fair value, okay. So first, when the PPE is transferred, you have to see what is the fair value at the date of change. Okay, you have to do the fair value at the date of change, and that fair value, what you do? You kind of got it in under OCI. Okay, you first find the fair value of the PPE in case of PPE, which is now transferred into IP. Okay, you find the fair value change, account it under OCI, and then now change it into IP. Okay. Now, in case of IP, again, find the fair value till the date of and then transfer. That is it. It is very simple. No need to look at permutations and combinations. Okay, even if it's carried at cost, find the fair value until the date of transfer, record that in PPE, and then PPE is now transferred into IP. Okay, vice versa, IPE record it under fair value. If it is going at cost, then that cost would be the fair value, which would of the PPE, which would be going further. So no need to look at that. Only remember two things. Find the fair value at the date of change, and then that fair valued asset is now transferred. We'll read that one more time. When transfer from investment property carried at fair value to owner occupied property or inventory, the property's cost for subsequent accounting under IAS 16 should be its fair value at the date of change of use. That's what they're saying. Do the fair value at the date of change, and that would be the other person's, the other investment properties cost, whether you are using cost or whether using fair value model, whatever it is. do the fair value until the date of change of change. Conversely, owner occupied property may become an investment property, need to be carried at fair value. An entity should apply IAS 16 up to the date of change of use. It should treat any difference at that date between carrying amount of the property under IAS 16 and fair value under revaluation under IAS 16. So basically, if PP is transferring to IP, do fair value until the date of change, carry that fair value in OCI, and then transfer the PPE to IP. Reverse, whatever is the IP, calculate the fair value on the date of transfer. Difference in fair value charged to P&L, and the remaining, and whatever is the IP, now transfer it as PP. Let's do one. Is it clear? Is it peripherally clear? No need to go by the words, or don't need to look at the permutation. Do a fair value calculation at the date of change. Record the fair value as PPE or IP as the case it is, and then transfer. Okay. So whenever there is a change, calculate fair value till the date of change. Okay. Then that fair value, if it is originally a PPE, then take it to OCI. If it is originally an IP, then take it to P&L. And then in the end, transfer from PPE to IP or vice versa. Okay. Is it clear? These are the steps to be followed. Okay, just do the fair value as on the date of change. Don't need to go by all these things and don't go by the language. Tell fair value change and then account for the fair value, whether you are a PP or IP, and then transfer the asset. So let's do one question. A business owns a building which has been used as head office. In order to reduce cost on 30th June 20X9, it moved its head office functions to one of its production centers and is now letting out its head office. Okay. So what is happening? So it has been using it as a head office. So it was a PPE and now it is now being recorded as what? IP. It moved its head office and now letting out its head office. The letting out of property is not considered to be the main business activity. So it's not an inventory. It is a IAS 14. Company's policy is to use fair value model for investment property. The building had an original cost on 1st January 20X0 of 250,000 and was being depreciated over 50 years. Okay. On 30th June 20X9, its fair value was judged to be 350,000. How will this appear in the financial statements of 30th June 20X9? So there is a transfer from what? From a PPE to a investment property. Correct? And PPE is worked out at cost. So it is this. Right? PPE, which was originally at cost, is now transferred into an investment property, which would be carried at fair value. Correct? So let's see how it goes. So first thing is what? Calculate fair value till the date of change. So what is the fair value? Not till the on the date of change. Okay. So what is the fair value? When is the change happening? Change is happening on 30th June 20X9. Correct? 30th June 20X9 is when they are moving from PPE to investment property. Correct? And they have given it. At 30th June 20X9, its fair value was 350,000. So we have already done step 1, 350,000. Okay. Now what is the second step? Account for fair value changes. Okay, we'll do account for fair value. First of all, what is the accumulated depreciation, etc.? So first thing is, right now, how is it? The cost of the asset of the building as a PPE has an original cost of 250,000. Correct? So 250,000 and there has been depreciation. How do you find depreciation? They said that was depreciated over 50 years when they have not given any scrap value. So it was over 50 years. Now, when was this bought? 1st January 20X0. And when was this transferred from PPE? It was on 30th June 20x9. So how many years? 20x0, 1, 2, 3, 4, 5, 6, 7, 8. 8.5. Sorry, 9.5. Correct? From okay. From 1st January 20x0 to 31st December 20x8. What was the depreciation? This is 9 years, correct? So 250,000 into 9 divided by 50. 45,000 is the depreciation. Then we are selling it on 20x9, correct? 20x9 to 30th June 20x9, correct? For 6 months. So that is going to be divided by into 1 divided by 50 into 0.5 because it's only for 6 months. So total depreciation is accumulated depreciation is this. So carrying value is what? Did you understand the depreciation calculation? Yeah, 9.5 because it says in this question that it was transferred in 30th June 20x9. Okay, it moved its head office function. So 30th June 20x9 is when I'm moving it from PPE to IP. And I bought it on 1st January 20x0. So once 1st January to 30th June 20x9 is 9.5 years. Okay, so here I'm taking 9 years for simplicity for understanding the calculation, and here I'm taking 4.5 years. So total depreciation is this, and carrying value is this minus this minus this. Okay, so the carrying value is how much? 202. 500. Yes or no? Did you understand till here? Yes or no? Hello? Am I audible? Is it clear? We are just doing the accounting. It's not done yet.
Yes, yes.
Okay. So we have taken, so the current carrying value as on 30th June on the date of transfer. This one is 202 500. Now I have told that the fair value is actually 350,000. So what is my revaluation gain? 350,000 minus 202 500. So my revaluation gain is going to be 147 500. Okay. Now it is going to be 147 500. So what do? I first account for the revaluation changes. So what would be my journal entry? First, to record the revaluation gain, what would be my journal entry? So what is the cost? 250. It is becoming 350, right? So asset account debit or PPE account. How much is PPE account debit? 250 being the cost is becoming 350, right? So it is going to be 100,000. Accumulated depreciation. Accumulated depreciation account debit. What was the accumulated depreciation account? I am writing it off 47 500 to revaluation gain. How much is it? 147 500. Are you clear with this entry? Are you clear with this entry? Okay. Now, once I have kind of taken it into like, now if the presentation would be what? The PPE would be 350,000, right? And the accumulated depreciation would be zero, and there would be a revaluation surplus of 147,500. Correct? This would be the presentation in, yeah, this would be the presentation in SOFP. Correct? Now what am I doing? I now transferred it into fair value. I did account for fair value changes also. Now what do I do? I will transfer. Now I will transfer from PPE to IP. Now PP is all ready, with the fair value amounts. Now I will transfer PPE to IP. Now what would be the entry? Entry would be IP asset, debit, PPE asset, credit. And it would be for a value of 350,000. Okay. I will transfer the PPE to IP. So now the revised one would be, instead of PPE, it would be IP for 350. Accumulated depreciation is nil. Revaluation surplus will stay there. This is what happens when you are transferring from one head to another. Now, if it is PPE to IP, account for fair value. Even if IP to PPE, again account for fair value changes and take it there. And PPE, if it is cost, the cost would be the new fair value of it. Okay, of the transfer. Is it clear? Now, in that way, you can do all these permutations and combinations. Yes or no? Just remember these three steps. Calculate FV till the date of change, which would be there in the question. Then we do the accounting for fair value changes and then account the asset to the other. Okay, perfect. Now this, the problem is, if you read the book, right, it is not. Now we'll see the solution. See, original cost is 250, depreciation for 45,000 and 2,500. So carrying amount is 20,500. Revaluation surplus is 147. Okay. So total fair value is 350. Difference between carrying amount and fair value is taken to revaluation surplus because it's currently an IAS 16 asset. However, the building will be subject to fair value exercises at each year, and these gains and losses will go to P&L in the investing category. In the end of the following year, fair value of building is found to be 380. 30,000 will be credited for profit and loss. Okay. Now disposal. When do you dispose? When you de-recognize investment property? Same. Okay. When it is not probable that future economic benefits will arise, or if I am kind of like, selling it to somebody else. And is permanently withdrawn from use, or no future economic benefits are expected from its disposal. Any gain or loss on disposal is the difference between net disposal proceeds and the carrying amount of the asset. It should generally be recognized as an income or expense in profit and loss account. Same like PPE. Okay, profit on sale of asset goes to SOPL, right? That's it. So that is all regarding IAS 40. Okay. Now, is it clear? It's just like PPE only. So first thing you have to see is whether you understood the definition of PP, definition of IAS 40. Then you have to see how it is recognized. Okay. And then there is measurement. Measurement, like initial measurement, is based on cost, and subsequent measurement is based on cost or fair value, not revaluation method, revaluation value. And then there is like, transfers from it is the most important thing, because you have to take it to the fair value before the date of transfer and then transfer it. Other than that, things are all pretty fine, clean. So any doubts there in IAS 40? Any doubts? Okay, fantastic. So we'll take a 5 minutes break and continue. IAS 23 is not going to be much. We can complete it in half an hour. Would you like to go forward and do it in the next half an hour? Or should we do it tomorrow? Because after this, the lesson is over. Then we'll look at new lessons too. Can I take half an hour more? Yes or no? Okay, we'll do it now. Fantastic. Yeah, sure. We'll take a 10 minutes break. I'm just surprised that it's coming from Sahil instead of Melvin, but then it's okay. Let's take a 5 minutes break, not a 10 minutes break, and we will reassemble. Right now, it is what time is it in UAE? It is 12:13 IST. Okay. So we will come back at 12:20 IST. Whatever it is in UAE, you do the math. Okay. Thank you.